I've just put in a reminder on the group, so I'm hoping for more participants to join in. Usually, I give the first 5 to 6 minutes for this to happen so that people can benefit from the class. Yeah. Yeah, just a brief introduction. My name is Ade. I'm the face behind the name, and we had a very successful webinar that was January, and the feedback was fantastic. And from your questions, I was able to sieve the everything regarding insurance. And like I've always promised, I wouldn't, regardless of how much I know and how much trust you have in me, all thanks to you. I always want to act within my professional limits, which is the right thing to do. And that's the reason why I go all out to get, you know, someone, the credible person who would act in our best interest. And, he's here is Mr. Charles Adautin. Yeah, so hopefully we are definitely going to have all our questions answered today. Um, and we're going to keep the time. So yeah, we have more attendees now. Let's just give some time. We are usually, very good with this, so I wouldn't wait for too long. Yeah, it's going to be a run through. So how it's going to be structured today is we're going to have questions and answers for the first the PowerPoint presentation, which is a direct response to the questions you have submitted in the Google form. So that is what this PowerPoint will be based on. So we're going to run through for 30 minutes. Please don't leave. After that, once we clock it at 30 minutes, then you can flood in. Everyone will be allowed to talk, and then you can come in with your questions. And there can still be, just like Mr. Swale gave the follow-up one-on-one session, I'm sure we all would have that with him. So if you still want more, there will be opportunities for that afterwards. Okay, so this is 2:05. I think we can start now. We are 22 now. Maybe we should. Let me ask him if he wants to wait. Um, Hello, Mr. Charles. How you doing?
Hello. I'm all right. I'm all right. Can you hear me?
Yeah, I can hear you. Do you want us to start now, or should we wait for more to join? We have 23 attendees now, but I
I'm
believe
okay
we
to wait if
have.
I'm okay
Say that
to wait.
again.
So I'm okay to wait for a couple of minutes.
Yeah, okay to wait for a couple of minutes. Okay. While we wait, I don't mind sandwiching this with questions. I usually want to maximize our time. Is there anyone who would want to say or ask questions before the meeting starts so that we just don't wait in silence? If you want to, you can raise your hand and I would allow you talk. If there's anyone with questions, particularly maybe someone who wants to leave early, someone who wants to, some of us work evenings. Okay, we have more joining. Okay, so while we wait, I just want to give this preview. One thing is common to all of us here, and that is the relocation. We are all moving down to Canada from the UK, and most of us are coming in our prime. When I say prime, I would say late 30s, early 40s. So we've got children, some of us, spouses, and our health. And like I've always told my peers, our greatest asset is ourselves. We've invested so many years reading, studying, bagging all these degrees, and amassing years of experience. But the body is a depreciating asset. It's good that Canada is very welcoming, and we all start at a very steep financial peak. But one thing we want to consider is preserving and multiplying our assets. When I talk about assets, not just money, our health, our wealth, relationship, and several things. This is about the time we start thinking about retirement. And retirement means different things to different people. So if we talk about when we land in Canada, relocation is not just about living. When we come in here, we want to get the best job, we want to get the best career, work-life balance and deals and contracts. At the end of the day, it's towards making money. Now we've talked about um, tax management, you know, and everything within with Dr. Swale. Now we want to now talk about wealth preservation, generational wealth transfer, risk reduction. Like I've mentioned, the body is a depreciating asset. We won't be, even if our brain is still functioning, the body, from one joint, from one aches and being. So we need to think about life insurance, critical illness, disability, and all things like that that we really don't have to bother about while we're in the UK. So this is all is going to answer. And yeah, sit back and enjoy. I think we should kickstart now. This is about 10 minutes into our time. So I'm going to make you the host now. I'm going to spotlight you, Mr. Charles, so that you can, yeah, so that you can share your PowerPoint. And are you rejoining or do you want to,
Do I have to rejoin? Okay, no, I'm fine now. I'm fine. I can share now.
you can share now? Okay. All
So
right.
I believe we can all hear and see me.
Yeah, so they can't talk unless they raise their hands.
Okay, no problem. But
Yes.
you can hear me, right? And you can see me.
Let me make someone else so that I can hear if. So, Dr. Akimolayo, can you hear us?
Yes, I can hear you and see you both.
Oh, thank you. Thank you.
Thank you
Yeah.
very much. Thank you.
All right.
So one more request to share screen, please.
Oh, to share the screen. Okay, give me a moment. Uh, Participants. I think you should be able to share your screen.
And saying the host isn't allowing sharing for this webinar.
You should be able to give me a moment.
Okay.
So, okay. So what I would do is I would make you the host. Okay.
Okay. Oh, nice. I can stay now. Okay. Confirm you can see my slides.
Yeah, yeah.
You see my screen. Oh, beautiful. Okay. Okay. So, good afternoon, good evening, good morning, everyone, depending on the part of the globe you're joining from. Um, I want to start by apologizing for, the way my voice sounds. It usually sounds really nice, but right now I'm a bit under the weather. So I'm sort of struggling to speak properly, but I'll pilot the session very well. Okay. So today, like I just said, we'll prepare this presentation to directly respond to the questions you guys asked, and I'll be running through it in 30 minutes. First of all, my name is Adautin, and I started Adautin Wealth, to to contribute my quota, you know, to help immigrants like me, not just immigrants, but like Canadians also who were born here, and mostly immigrants like me to win with money, right? Especially people who are privileged and people like you who would just be walking into the top 1% of Canadians. So that's a rare privilege that you need to make the most of. So my job is simple. I'm trying to work with as many doctors as possible to ensure that high income translates to high net worth. Um, um, I'm licensed to practice in most of the provinces and territories in Canada, and I want you to be rest assured that you are listening to the best best in this field. In February this year, I was awarded the top producing insurance advisor in Canada, and that award came from the top MGA here. So I want you to sit back. I've helped so many professionals like you, so much that 95% of my clientele is made up of physicians. The other balance mostly the founders. Okay, so today we're going to be speaking about five different things. One, tax efficient wealth strategy, corporate structures, retirement planning, insurance planning, and intergenerational wealth. So these topics, basically came from a grouping of the different questions you asked that related to wealth building and insurance. So we are going to first start by looking at the tax efficient wealth strategies that we have, right? Canada has many structures, to build wealth, but it's one thing to build wealth, it's another thing to build wealth and then hand it back over to CRA. So it is very important for you to understand, um, the different vehicles and when these vehicles come to play and how best to maximize them. Before I get into discussing the vehicles, I just want to make you understand how you interact with money. Because why I'm saying this is um, I've had a one-on-one session with over 500 doctors, and in speaking to most doctors, I see that when doctors think about financial planning, financial saving on taxes, most times they only think about how they save tax on the way they earn. It's always about the way they earn. How do I pay myself? How do I do that? But you have so many interactions with money, and at every interaction point, you get taxed. When you earn money, you get taxed. When you keep money, depending on how you keep it, you get taxed. When you spend money, you get taxed. The tax can be more depending on how you spend it. When you save money, you get taxed on it, depending on how you save it. When you borrow money, you get taxed. Sorry, no, when you borrow money, right, you can make it tax smart or not. When you borrow money, you can make it tax smart or not, or not, right, by ensuring, okay, is this loan I'm taking, can it be tax deductible? Can the interest be tax deductible or not? Okay. And no, and also even when you invest money and the money grows, right, it's triggers taxation, depending on where you invested it. When you give money, depending on how you give it, it can trigger, distribution rules and deemed disposition, right? To give, depending on how you give it out. It can trigger taxes in some way. When you receive money, most times, if it's depending on how you receive it, right? It may not be taxable, but if that money grew before you received it. Let's say your dad had $1 million invested somewhere, the million grew to $2 million, and you received the $2 million as inheritance. Because that growth, he didn't pay tax on it, you have to pay the disposition tax. And when you transfer it, so every interaction you have with money deals with taxes. Now, there are ways, so when you think about lowering your taxes, don't think about at the point of earning it. Think about at every point you interact with money. Now, this presentation is going to help with some of these things, but of course, it's 30 minutes, and there's so much we can discuss about in 30 minutes. The next thing is, there was a question that said, how do I reduce taxes using planning vehicles?
Yeah.
One thing you want to understand is, when you come to Canada, you from a you wear so many caps, right? You
Mm.
are Dr. Adesola, you are Dr. Adesola Medicine Professional Corporation. That's your identity. You are also a family because you have a family to run. You are also the staff of a company. So in Dr. Adesola MPC, you are the owner of the company who has a responsibility to make sure the company grows, succeeds rather, succeeds. You're also a medical doctor who is an employee of the company, whose job is to make sure that the patients get the best service and all that. So because you have these many caps you're wearing, it is very important for you to understand what is expected of you in each of these caps. Now, one of the most important and most powerful tool to to lower your taxes is by having a professional corporation. Because professional corporations are taxed. The taxes you pay on corporate income is between 9 to 12.2%, depending on the province you practice in. Manitoba has 9%, and Ontario has about 12.2%. Now, how does a professional corporation help you save on taxes? Because you are able to determine how much you want to pay yourself, right? You can decide how much you pay yourself. You can decide to retain most of your money. You can decide to be, a bit creative with your expenditure, right? So that way, that creativity around expenditure, allows you um, to to claim tax deductibility on some things that would typically be a little bit harder if it was money was earned as personal income. So the professional corporation is very important, and I always advise most doctors when they ask me and say, "When could I incorporate?" I said, when you start working, just incorporate right away. Just incorporate right away. Now, after you incorporate, of course, it's going to get to a point where the money you earn, the money you earn is way more than the amount of money you need, right? So those surpluses, those retained earnings, people typically move those retained earnings to a different holding company where they have that flexibility, to spend money to invest money on anything they want to invest in due to the restrictions that exist in the professional application. Now, one of the most important tax vehicles, in my opinion, the only tax exempt vehicle a corporation has to grow money in Canada is through the use of a permanent life insurance and a shared ownership critical illness policy for split dollar CI. These are the only two environments where you can grow money and you can be rest assured that taxes will not be triggered. But outside that, every other avenue you invest money within that corporation will lead to a huge tax, up to about 50%. So on the personal side, the government gives you a lot of opportunity personally to pay less taxes. One of them is the tax-free savings account, where you can invest money in TFSA. Any money you invest there grows tax-free. You don't pay tax on the growth. So 7K becomes 10K, that 3K is your money. First Home Savings Account is another one. It's an account the government allows you to open, so you can save money towards the purchase of your first home. The limit is about $8,000. Okay, and this account is gonna die a natural death when you purchase a house. But one thing I need to make you understand is TFS say once you become a resident of Canada, what happens is you have that account. You have the room pile up every year once you become a resident. But FHSA, you need to open the account first to start accumulating the room. That's why when you come in, that's usually one of the first things you do. Okay. RESP, Registered Education Savings Plan, allows you to save money for your children in an environment that doesn't trigger taxes. And in future, the tax would be based on the child's income. And then you have IP, Individual Pension Plan, and RRSP that can allow you to save towards your retirement. Now, other thing that is not here is the primary residence. A primary residence is also a very, very important tax vehicle. Because if you buy a property at $1 million and sell it in future at $5 million, the whole $4 million is your money. You don't pay tax on that. So that's something else I'd like to flag. Now, one key insight is if you need to, as the head of your company, you need to ensure that the active business income your corporation earns is less than $500,000. This is very important because if you earn more than 500K in active business income within your medical corporation, then you cease to be a small business and you can start paying taxes at a higher rate, over 26.5%, depending on where you are. Now, the other thing is if you use your corporation to grow passive income, let's say you have a medical corporation and you put the money there, the net income or the return earnings in stocks, for instance. And once you earn more than 50K, you start to lose this business income room that you have, this small business room that you have. And that's very important. So rule of thumb, don't earn more than $50,000 in passive income within your corporation, and make sure
Active or passive?
don't earn more than $50,000 in passive income within your, and ensure your active business income doesn't exceed $500,000. Another thing is, one thing I also want to flag is the reason why many corporations use life insurance as a way to grow money is because it allows them to avoid these things. If you grow money within a life insurance policy, it doesn't trigger that 50% taxes because growth within a life insurance policy is tax exempt. That's number one. Number two, it doesn't make you lose your SBD room or $500,000, your small business room, because every growth within a life insurance policy is tax exempt and doesn't lead to FBD grind. It doesn't make you lose that room. And again, it doesn't count as a passive income, right? So you're not going to pay tax on it, and you won't lose any of your SBD room. So I wanted to emphasize that as much as I can because it's one of the most important things I'm going to talk about today. Now, the other question was, what are the best investments through a corporation? The one investment that is very important, that is good, is you're a doctor. Of course, when you open more clinics, when you open more clinics, that's your forte, right? When you open more clinics, or when you do anything in the medical line, maybe by getting medical equipment, opening an anesthetics clinic, whatever, anything in your medical line is considered active, right? Because you are still in your area as a doctor. But outside the medical field, right? Whole life, whole life or universal life insurance is the most important asset class for a corporation. And the reason is because it is the bedrock upon which you can build other things. So when you have money in insurance, in whole life insurance or universal life insurance, what happens is, one, the growth is tax free, and number two, you can get money from there to invest in real estate. You can get money from there to invest in ETF. You can get money from there to invest in private, any other thing. So it's just a place your money resides because any growth within there is tax free. Now, of course, investment in ETFs, just the way you guys, did in the UK, you can invest your money in ETFs and stocks and try to target, investment in stocks that will give you capital gain. Because that way, at least, even though the tax is high, um, you're only paying tax at 50% inclusion rate. So overall, maybe we're paying something in the region of 20 something percent in taxes. Real estate holdings, but please don't own real estate with your medical corporation. I don't advise it. I prefer you open a sister company, different real estate company, and then, find a way to flow money, to get money across there, depending on the province you are in. If you're in Ontario and Alberta, maybe you can have to structure through loans, to that company. But if you are in other provinces where there's a bit more flexibility around the holding company being able to own shares of an NPC. So private investments come up a lot, right? There's always different groups of investment groups where doctors, form with their friends. Sometimes this can people do this, they invest in private equity, invest in partnerships, invest overseas, and invest some money in startups. But you have to understand that some of these kind of investments can be high risk, right? So you want to put a tiny bit of your money. It's just a tiny gamble, right? So, but the bulk of your money should reside where the risk is less, which is permanent insurance. And then you now take the smaller portion of your money and put in other investment types. But then if you invest within the corporation, again, I'm saying it again, in ETFs and stocks, just ensure that you don't earn more than $50,000 in passive income. Then, so let's discuss corporate structures. How are corporations structured? Now, as a physician here, you're going to have a medical professional corporation that is restrictive in nature because as far as CRA and the government is concerned, your job is to be a doctor and attend to patients, right? It's not to use a corporation, for things like for real estate. That's not it. If you want to do that, you want to make sure that you do it in a different company. Right now. So typically, what people do is, you have an NPC that does billing. Always remember, you are a high income earner. You are a high net worth individual. What does that mean? It also means that you are an easy target for litigation. Litigation can come from anywhere. Your staff can come from your staff, can come from a patient who slips and falls in your premises, can come from anywhere. Even contractors who work on your basement, it can come from anywhere. So you need to always think of how your assets are protected from your operations. As a doctor, you're more prone to to litigation within your medical professional corporation. So that is not a good place to keep your assets. When you have retained earnings, right, that are coming up, you want to move those retained earnings to a holding company that is separate from that medical professional corporation. And then within the holding company, you can now do the investment in assets as you like. But you also need to understand some things. Note number one, that the holding company doesn't make you it doesn't make the income not be passive income. It's still passive income. It's still gonna be treated as passive income. Just know that. But the only thing is that you now have flexibility. Number one. Why? Because unlike the NPC, now you are in a place in a holding company where you can invest in whatever you like to invest in. That's number one. Number two is asset protection. So because the liabilities of the holding company is limited, the liabilities of the NPC is limited. So if the NPC has a problem with litigation or creditor, it is limited to that corporation and then you can protect your assets, which is your retained earnings or your real estate holdings from those kind of things. That's one. So that's two. Number three, if you are in provinces like Manitoba, BC, where the holding company is allowed to own a product, to own shares in the professional in the NPC, then that's even easier because you can just do intercorporation transfer can just pay dividends from your medical professional corporation straight to the holding company. But in a place like Ontario or Alberta, that is not possible. Here, you can only use loans to do that. And in terms of control, in your medicine professional corporation, only doctors are allowed to be voting shareholders of that corporation. Okay, so if your wife is not a doctor, your wife can only be a non-voting shareholder, right? But you have to be a doctor to be a voting shareholder of that corporation. But now, if you've moved the money, the retained earnings to a holding company, in the holding company, you can decide who votes and who doesn't vote. Do you understand? You can decide to do the shares as you like. And it will help you with estate planning because you can implement things like estate freeze that allows you, let me not go that deep. But generally, it's good to have a holding company, you know, and use that to hold your assets. Sometimes, even including the life insurance. Sometimes people ask the question and say, what happens when I've retired? I'm not going to have these two holding companies. Yes, of course, you can amalgamate them at that point. Now, then the other thing I want to talk about, related the same thing. Now, the MPC, the question was, how does the MPC and holdco strategy work? You have an MPC where you earn active income. Okay. This MPC, you have an MPC where you own, where you have active income, and now this MPC has this MPC um uh uh it gets money across to the holding company, either as a tax-free dividend in some provinces or as a loan in Alberta, Ontario, or Newfoundland, to the holdco, and then the holdco now holds all the investment. Let's say the holdco has another real estate company, the holdco has another company abroad, that is invested in something. The who can just own and control all the investments. Now, the next thing is the next question was about investing globally through the corporation. Now, just to say it across, you shouldn't invest globally with your MPC. Okay, don't invest globally with your MPC. Try to the goal is keep your MPC as pure as possible. That purity is very important. Purity in the sense that as much as you can, let your empathy be only used for patient care and to earn money from patient care. And if you have to do a lot of things, it's always good to do it elsewhere, just to keep that purity. Now, investing globally can be done through the holding company, right? Can be done through the holding company. And there are different rules that govern cross-border tax between one company and the other, depending on if there's a tax treaty between the two countries, or if there is what you just want to do is to make sure that you speak to qualified professionals in both countries. That is very important because there's so many possibilities, but you want to make sure that you're taking the right decision. The one thing I did not mention about holding company is there's a way you can make a holding company, behave like an active, um, the income of an holding company to be active, right? And things like this we can discuss, when we get into the point where we have one-on-one sessions. So because without that, the holding company is going to be treated as passive. Income in the holding company is going to be treated as passive income, right? And also affect your SBD grind. I need to also mention that. SBD grind means your small business room of 500,000 grinding down to 200,000. Whenever I say SBD grind, that's what I mean. It means your small SBD is small business deduction. Room is you have $500,000 room that you can earn without um, uh, um, um, and you see the tax as a small business. Once that grinds down to like 250K, it does mean that once you earn 250K and above 250K, you're no longer a small business. You are a regular corporation, and your taxes would be higher, like 26 point something percent. So whenever I say SBD grind, that's what I mean. And whenever I say passive income rule, I mean earning more than 50K in your corporate one, which leads to SBD grind. Okay, so I just wanted to make that a bit clearer. Now, the next thing is with retirement planning. Okay, now for retirement planning is the portion I'm most passionate about. Actually, retirement planning is where most of my passion lies because the gap is enormous. Now, like Ade rightly said, we are coming here 35, 45, 40. It means we are running a race against time. If you come here at 40, you have just about 25 years if you're retiring at 65. 25 years to take care of yourself, your family, pay your bills, send your kids to school, college, and still be able to save enough money so that when you stop working at 65, you can take care of yourself. And remember, there's inflation. So what $100,000 a year can do today, you would probably need 181,000 to do the same thing 20 years from now. So so you need to think about these things and take retirement planning very personal. So let's look at the questions that came here. So one was, is early retirement possible? Of course, early retirement is possible if you think about it and do something about it. So first is, of course, you accumulate money now that you're strong. You're strong, you can see 50%, 70%. You can't do that 20 years from now. There's no chance. So now that you can do that, you do that and you prioritize your needs. One of the most important asset accumulation needs, you have three, actually. You only have three asset accumulation needs. One is your retirement, one is your children's college education, two, and number three is your primary residence. So when you accumulate this money and then you go to transition where you start to reduce the hours you work for, you can't be saying 60% up to age 55, right? And then you slowly transition until you go to the point of independence where you're just working because you want to gist with patients, not really because of the money, right? Now, now, um, the other question is, how do doctors invest tax efficiently for retirement purposes? Now, before I speak about that, I'm going to talk about the three-part formula for retirement, retiring early. One is define what the target is. Retirement means different things for different people, right? So your retirement is determined by what we call your financial independence number, right? Which is basically what nest egg do you need to have? What capital do you need to have in order to say, yes, I don't have to work again because if I invest this capital at 4% every year, for instance, what I'm going to get in returns every year is enough for retirement. That is when you can say, yes, you've retired, not really the age. But then, if you want to define the target, you can decide at the age you want to retire. Let's say you want to retire at 65 and decide how much income you want to earn upon retirement, right? And then you start building, and then you ask yourself the second question:
Mm.
if I want to earn 200K in today's money upon retirement, now what would that money be by that time after inflation? When you know what that money is, and then you start to put up your next egg towards it. But the question is, how do doctors invest tax efficiently? Number one place, and the most important place, is tax-free savings accounts. That's the number one place, which is similar to Roth IRA they have in the US. TFSA is tax-free, so of course it's the first place. Then after that, the second place is within a whole life policy. Within a whole life policy, because just like the TFSA, you can, from start to finish, you can totally avoid taxes in these two vehicles. Outside these two vehicles, there is no vehicle in North America, in Canada, where you can plan for retirement without taxes, just so you know that. PPP and RRSP comes in later. PPP, RRSP, and there's another one called PPP. So these vehicles allow you to grow money.
Do you
Uh,
mind telling us what PPP is?
I,
Uh,
uh, it's personal pension plan. It's a new product debuted by a company. They've been reaching out to me to get them to speak to doctors. So maybe um, that's something we can discuss in a different session. It's personal pension plan. It's not very old. It's a new strategy. Right. Yeah, it's a very new strategy. I'm even still studying it myself to see the vulnerabilities before I start sharing to my clients. Okay.
so what
Now,
does what is RIRP?
so IRP, okay, IRP is in short retirement plan. In short, retirement plan. That is a retirement plan that is based on insurance. So it has different names: IRP, IRS, Insured Retirement Strategy. Manulife calls it Insured Retirement Plan. Credible Life calls it Insured Retirement Strategy. So the way it works is, okay, I have an example. I'm going to show you an example here. So in the next few slides. So the three-part formula is define the target for retirement, which is your retirement age and what you want to earn every year in retirement, adjusted for inflation. And then build capital. You will start building capital today towards our retirement. And when retirement is when that capital is complete. So even if you wanted to retire at 65, but you've been able to achieve your nest egg at 60, you're retired. You're just going there, you look for five old agents like you, and just sit down and think about Donald Trump or whoever is going to be the president at that time. So that's the way these things go. And then when it comes to the point of retirement, this is very important also. There's something we call income sequencing in retirement. Income sequencing means you have money in TFSA, you have money in whole life or insured retirement plan, you have money in IPP or individual pension plan or registered retirement savings plan. I think I'm not defining these things enough. Registered retirement savings plan is what RRSP is. Registered retirement savings plan. Or you have money in ETFs, real estate. You cannot take all of them at once. You need to know which one do I deplete first and why. Which one do I deplete next and why? At what age does it make sense to start taking money from RRSP? Which one do I do at 60 to 65? Which one am I going to use 65 to 70? Or do I just take money from all of them at the same time? So this is something that is also very important at that point. But thank God I'm going to be alive to see everybody here retire. So, so I'll be there to guide you. Okay, um, so these are the buckets: tax-free savings account, whole life or insured retirement plan, individual pension plan or registered retirement savings plan, and then corporate ETFs, real estate or private investments. Now, the next thing is how do you analyze your retirement need? Now, I put in a practical example here for those who like to use ChatGPT. You can go and ask ChatGPT. So the first thing is your current age. This is an example. This example is John Doe. So, sorry, John Doe. John Doe is 41 and says, okay, I want to retire at 65. Now, please, when you pick the retirement age, remember there is something called life expectancy. So if you retire at 65 and life expectancy is 85, it means you have 20 years in between. So you need to put in enough money that will last you for 20 years. But that is not for everybody. That is for regular people. If you come from the family that has longevity problems, which means everybody in your family lives up to age 105, the way you plan is different. Because 105 minus 65 is 40 whole years. You need to plan for 40 years, else you're going to outlive your retirement savings. And these are the reasons why we say retirement planning is so peculiar that you and your best friend can have everything the same. But when it comes to retirement, it can't be exactly the same. So we'll determine when you want to retire, we'll determine the life expectancy, and then with the desired um, retirement income, annual retirement income in today's dollars. And whatever the inflation is, we adjust for inflation to know what that money is going to be in future. If you look at this example, John Doe is 41, wants to retire 65, which is at 24 years away, right? He wants to earn 240K in today's money. Now, if I adjust 240K for inflation of 3%, that is $487,000. Okay, for $87,000, right? That is what the equivalent of 240K is 24 years away. And now you came late, so old age security is all you're going to get. CPP, you're going to get maybe nothing for most people, or if anything, it's going to be almost negligible. So let's not even talk about that. Now, that means this person needs to have a nest egg of $8.5 million at retirement to be able to achieve $487,000. And these are real numbers. These are real numbers. That's why you see that I put a sense of urgency around retirement and protection than almost anything else. And then this guy doesn't have anything now. But for most of you on this call, I know you have something you've done already back in the UK. Like maybe you have houses, real estate. Typically, in this kind of calculation, you put what you already have here, right? Not the current value, the projected value in future. You put it here and then subtract to know what the shortfall is. Now, when you have the shortfall, the question is, what do I need to put away every month today to be able to achieve that shortfall? And that is how you now decide at 8%, I need to put away $10,000. At 6%, it has to be $14,000. So for you now, you're fighting a race against that, against inflation and against time. So this is very important. Now, the right corporate and registered structure can significantly reduce the monthly savings burden to tax shelter compounding. So now, if you had to plan for $47,000 for a year for retirement, but now you're using whole life, for instance, to plan for that retirement. It means you don't need up to 487K, right? Because you're not going to pay taxes, so you need less. You need less money, maybe 200 and something or 300, because you're going to have a tax-free retirement. And I want you guys to buy some books and read. Books like there's the power of zero, there's the power of zero, there's tax-free retirement, and stress-free retirement. These books are going to, make you understand to have a retirement where you don't pay taxes. So that instead of looking for 487K, you're looking for maybe $300,000, and that would be enough because you're not going to be paying taxes. Okay, so now let's look at. I'm not going to go through this because of time now. But basically, the question here was, how do I replace the NHS pension in Canada? It's the same thing I've said before. PFSA maxed out for you and your spouse every year and invested in the right environment. Okay, very important. Invested in the right environment, and then you use whole life to grow your retirement money, so you can have a tax-free retirement. Okay, and then of course, when you maximize all of this, you use IPP, real estate, and all of that. Now, RRSP, IPP is not a tool I like putting doctors to, because most doctors don't fit into that bucket, right? But in my experience, I've also found doctors who fit into that. That's why I put it in my presentation. I found doctors who are not really working as hard as others. They just want to, take it easy. So their income is maybe 200 and something thousand dollars, right? Or 100 and some. They're not really making more than 200 to 50K. So that's some of these people who, RRSP can be good for, but most doctors, RRSP is not really very suitable for them. That's why most of them use whole life plan retirement. Then the next thing is what we call, is an example. I decided to put an example here, right? So we can see this is an example of an insured retirement plan using whole life. Now, the way this is done in such a way that this very one example is done in such a way that the same policy can do many things. So number one thing this policy is doing for this guy is number one thing is doing for this guy is that this money is growing within this policy tax exempt. So this 100K, instead of sitting in the bank, he puts it in whole life. So it's a bank where the money would reside. Now, by the time he puts it 10 times, this is just for 10 years, right? This is $1.2 million. So it has grown, it has added about 248K. It's exempt. And now he can access this money to invest in whatever else he wants to invest in. But then I want to show you what this policy can do in retirement. Now, this guy puts in 100K every year for 10 years, just 10 years. And when he retires at 65, he takes out $167,000 every year for 20 years, tax free. 100K every year for 10 years, but takes out 167K every year for 20 years, tax free. And if he was to pass away, his family will still get $2.7 million. It is even almost 3 times what you put into it. Right? So this is how you play the game and ensure that you don't pay tax today, you don't pay tomorrow. And these things are very important to understand. The next thing is is insurance planning for physicians. Now, insurance in Canada is not just protection. It's protection for your liability, it's protection for your Your liabilities are things like your loans, your mortgage, and your debt. Protection for your responsibilities, like taking care of your children's education and all of that. Now, insurance offers you, there are many insurance for each of these things. So you have disability insurance that replaces your income if you're not able to work due to an accident or an illness. Disability insurance. But the beautiful thing in Canada is that our disability insurance has a rider called return of premium. So when you pay for it, when you get to the end of the policy, you cancel the policy. When you get to the end of your practice, you collect 50% of your premiums. Right. That's great, and it doesn't matter even if you made a claim. They will just give you 50% of your money back less the claims you've made. Okay. There's health and dental insurance. Of course, you don't want to pay for medical expenses from pocket. There's professional liability provided by CMPA. And then the term insurance to cover your protection needs. Because I always disagree that doctors only need permanent insurance. You need a combination of both. Because you have some needs that are temporary, right? You have some protection needs that are temporary. You have some protection needs that are also permanent. Travel insurance, because you guys travel a lot, and you need to protect yourself in case you are in another country. Critical illness, so that if you get diagnosed of a critical condition, your practice doesn't suffer, your family doesn't suffer. You will still be able to get money and focus on more on your health, right? But the beautiful thing is in Canada, our critical illness comes with 100% return of premium, where you can get all your money back. And then corporate and permanent life insurance, I've spoken about this. And then business protection is you can buy an insurance to protect your business, in case something happened to you. And advanced strategies like what I just mentioned, in-stock retirement plan, shared ownership critical illness, and IFA, which is immediate financing arrangement, which is still based on whole life. Now, what is the difference between permanent life and term life? This is another question. Simple. Difference between term life and permanent life. Term life is renting a home. It's like renting a home. Permanent insurance is like owning a home. That's the best way to know the difference. Term insurance is you need accommodation. You need accommodation just like you need protection, right? But now you can't buy, so you decide to rent and you live there. Now, by rent, both of you would have, in both cases you have accommodation, just like in both cases you have protection. But the problem is the lease has an expiry date, just like term insurance has an expiry date. Okay, which means you are more likely to outlive your term insurance because of the medical advancement and the fact that people life expectancy is increasing in most countries. Now, the other thing is equity. In term insurance, you have no equity. You pay, you pay, you get, you don't pay. That's it. Rent is cheaper than mortgage. Of course, that's why term insurance is cheaper than permanent insurance. Okay, so in permanent insurance, okay, let me take that again. Term insurance has expiry dates, just like rent. Permanent insurance doesn't have, you own the policy just like you own the house. Term insurance has no equity, okay? Just like renting. Buying a home has equity, just like permanent insurance. That's why we could say cash value, gross cash value has an equity. Permanent insurance is so similar to real estate. It's so identical. Now, rent is cheaper than mortgage. That is why um, term insurance premium is cheaper than permanent insurance premium. Why? Because permanent insurance premium, the money you pay is not just for protection. A portion of it is growing as a side investment within policy. Just the way rent doesn't have equity, so nothing grows. And then term insurance, in term insurance, the day you don't pay, they will pick you out. The same thing but in permanent insurance, you can go to the policy owner in universal life policy insurer and say, I don't have a lot of money for this month. Can I take a premium holiday? Premium holiday from your policy. Sometimes you can take premium holiday for like 3 years, 5 years, 10 years. I'm telling you, with in universal life. Even in whole life, you can take what they call automatic premium loan. So there's a lot more you can do with the policy if it's permanent, just like in real estate, than for term insurance. Term insurance is very expensive in the long run. So if you want to renew it, If you get to do buy term 20 and want to renew it, then it can become very expensive. And beyond a certain year, you can't buy term insurance anymore. But permanent insurance, once you get it, you have only one premium, and that's it. That premium doesn't go up again. Right. Now, permanent insurance solves more problems than term. Problems of legacy. You can leave a legacy for loved ones. You can grow money tax exempt, and you can also use it to strengthen your balance sheet. So if someone wants to give you a loan in the corporation, what they want to see is the assets of the corporation. Permanent insurance, you can show and say, okay, I have this asset here. So can you give me a loan to open a new clinic? So these are the things that are very important. Now, the next thing is what are okay, now we know term insurance, we know permanent insurance. Now, within permanent insurance, we have universal life and whole life, which are the two most popular. Whole life is more popular than universal life, right? But the main thing you need to understand between these two is number one. Number one is universal life is more flexible, it's slightly more flexible than whole life. Whole life works on prediction, it's predictable. So most of the things is designed is to give guarantees. So because it's designed to give guarantees, they also want that predictability from a premium payment standpoint. Right. Now, universal life has more upside potential. What do I mean? The main difference between these two is universal life is invested, the underlying funds are invested in the financial market. While whole life, the insurance company just says, pay premium, I'm going to make sure you get a return every year. Don't ask me what I'm putting the money in. It's not your business. I'm not going to tell you what I'm putting the money in, but I'm going to make sure that every year you get returns. You can never make a loss. It's mathematically impossible. It's historically impossible. Universal life, on the other hand, says, okay, when you buy this policy, we are going to invest a portion of this money in something, some investments in the stock market that you are going to sit down with your advisor and choose based on your risk profile. Now, this investment can go up, they can come down. So if investments go up and down, it will affect the cash value of the policy. That's the main thing you want to understand. Universal life is subject to market volatility, which means you can make 20%, you can also make -5. Whole life, you can never make 20%. You can't make 20% from whole life every year, but you can never make a loss. You see that between 6 and 8%, you're going to be playing around, right? Maybe 5 to 8%. Let's say 5 to 8%. You're going to be playing around there. Okay. Now, because of this and the way a doctor works, you can already see doctors that don't have time. You can already see where they could really naturally tend towards to. Right. The other thing is universal life requires active management. So you and your advisor have to be meeting from time to time, maybe every 6 months or every 1 year to look at the investments and switch some funds and rebalance and do all of that. Whole life is set it and forget about it. That's it. Except you only go back when you want something from it, as far as you're paying your premiums. Now, universal life is more flexible and customizable because it allows you to, you can, come back, say, okay, I'm not going to port premium, I'm going to increase it, I'm going to reduce it, and all of that. But whole life, to a large extent, once if you know that these flexibilities are required, you need to tell your advisor at the start so you can build it into the design of the policy so that if in future you can't really pay up to 100K anymore, you can actually reduce it to say 20 or 30K. It depends depending on how it was designed. Now, both of them can be corporately owned. Both of them will last for your whole life, right? So that means it will outlive you. Okay, both of them are pretty good, right? Then the next thing is can permanent life insurance be a wealth strategy? Of course. Plus is one of the best wealth strategies. That's why if you go and look at the asset declaration of Joe Biden, Joe Biden's asset declaration, I think it's online. You would see Joe Biden has 6 whole life policies. And if you scroll down, it has 6 whole life policies from Mass Mutual. If you scroll down to the liability section, you would see Joe Biden has you'll see a line there that says loans taken against the cash value of policies. If Joe Biden can do that clear, we can do it as well. So, government life insurance offers you tax-free growth, which means you're growing money without talking to CRA. Tax-free retirement, right? You can structure it in such a way that you have a retirement where you don't pay tax. Why? Because you don't have any income. You only have cash flow coming in, not income. Now, corporate ownership, you can own it in a corporation, you can also own it personally. And of course, collateral financing means that you can use it as a collateral to get money to fund other ventures, other endeavors. So the next thing is the next question was what corporate health insurance options are available.